Welcome everybody to the 8th, 2026 at 3:56 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I'm joined by the one and only, the Baron of Bonds himself, Brandon Beaver. Brandon, what's going on?
Have just you know what I have to brag a little bit. So I
You
and
have
not
to.
about myself.
He has to brag.
Not This isn't about myself. I've got a girlfriend that had to pressure me to buy a second PlayStation for Valentine's Day for her.
Oh.
So now, like, when I come home from work, if she's on like Dreamlight Valley or playing like one of her games like Farm Together or something like that, I can jump on NBA 2K and I don't have to worry about it. But she had to pressure me for it because I'm kind of a tightwad. So
Well, there you go. I mean, it
But
sounds like you have a
like
great relationship.
I was thinking about that. I was like, dude, like, I got a girlfriend that just pressured me to buy a second PlayStation. I can't be too mad about
No,
it.
you
You know?
can't. You could
No.
be very happy about it. Yeah.
Right, exactly.
So sounds like you guys are doing wonderful.
Yeah.
Nice, nice. That's good to hear, man. It's good to hear.
Maybe
I
one
just,
day we'll get to this laundry that's been the same for 2 years.
just leave it. Eventually, you'll sell the house. Somebody else will get
Yeah,
it.
right.
um,
That'll be part of the deal. You have to take this. I'll take
yes.
5 grand off the closing price, but you have to take this.
There you go. There you go. Yeah. No. I did not hear that there was a podcast last week. I was in Europe. I thought you were gonna bust one out with Nick or somebody, and
I was
nothing.
going to, and then I was slammed. I'm sorry. I took it as the time to get
Man.
caught up on personal things. I had a lot to talk about. We talked about
Uh,
the whole Disney deal. I wanted to tell people why I stayed in Disney. But yeah, it is what it is.
Well, I was skiing on top of the Matterhorn. It was fun. Did fun things in Switzerland. Spent the day in London. It was great. Had a fantastic time overseas. Nobody came up to me saying, "Hey, you did chinchilla picking guy." Sorry, our Swiss audience that's been listening since the beginning. You guys did not show up to me in Zermatt. Very disappointed.
You, you know what the weird thing about London is? And I
What's
didn't
that?
know when I went back in 2013, I think it was. We went over the summer, and nobody warned me about the fact that the sun comes up at 3:30 in the morning in the summer in England. I didn't
Eh,
know. Freaked me out.
yes or no? It all depends. But
I woke up, I turned over, I looked at outside and I was like, it's getting light. Like, did I oversleep? Because we had a lot of plans for that day. We were going to get up at the crack of dawn. And it was the crack of dawn at 3:30 in the morning.
I think your clocks weren't set right or something.
Oh, I swear to you. I swear,
Yeah.
3:30 in the morning, that sun was coming up.
Well, anywho's, a lot of things happened in the market recently. I know back in at the end of last year, Brandon, you had made a decision or a theory you had. If you look back at our previous podcast, I'm sure you'll be able to dig it up and find it or ask AI to look for it. But you had a theory about oil. And I said, I don't know, man. Oil's been stuck in a rut. I don't know if this is going to make a difference. And sure enough, if you look at a chart, come the new year, come in January, the first week of January, all the stocks started just all moving up. And every
Okay.
single one of their charts,
What was
bottom
my
left,
theory?
top right,
What was my theory?
you said
What
that
was
they
my
were
theory?
all going to move up. And I
Okay.
forget exactly why the catalyst that you said was. And I'm the oil guy who always researches oil, was like, I don't know. I don't see it. Turns out you were right and I was incorrect. So much for having all that research behind my this brain of mine. It didn't help me at all. Got that completely wrong. And you just throwing out a hunch like I think this might happen because of this, and you got it right.
I
So
wonder. I mean, I would assume that it had something to do with monetary policy and macroeconomics because I'm usually pretty good with that, or maybe interest rates even. I don't
yeah,
know
I
'cause
mean Exxon's at 145, and at that time it was at 118. So that was a nice healthy jump up. Same with Rig, Transocean. They all got similar jumps up. Conoco, everybody. And I think it was Venezuela might have been the catalyst as well. Wasn't that around that time? First week of the year?
it might have been.
Yeah. So I mean, there was a lot of things happening around the first week of the year that, really caused these oil stocks to jump up, and they all have. They've been consistent, and that's one thing I'm going to take a look at this week to see if that stays consistent or if that's something that's just a one-off from Venezuela and other issues that have happened. And if this is going to stay, I can't believe I missed it. First of all, I can't believe I'm just. Well, I do. I can believe I miss it, and I can't. I can believe that I just now getting around to it. For all of our listeners, I've been off for not off like off the podcast. I've been off, as in like my what do you call it when your mojo, your energy, everything's off a little bit, right?
Right,
So
right.
I've been off about, I would say, what do you say, 6, 7 weeks, Brandon? I've been kind of off, not really responding to text messages, kind of just chilling. And
Yeah.
so I think that's why I missed it. I just have had too much going on that I just missed it. And that's why I haven't been trading that much. I haven't been investing that much either because I realized that about myself. And I'm using my personal story to tell people like when you realize you're a little off and you're not giving your full attention to things, that's the time to take a pause because that's what I've been doing. I've been stepping back. I've been really relying more on Brandon's recommendations, ASFL. I got into that one. I was like, okay, but like listening to the other guys in
Yeah.
the group and kind of listen to all you guys and tell you guys, throw out your recommendations, and I'm looking at them and I'm like, that one might be good, that one might not be good, and but yeah, that's what I've been doing because I have. If you notice, I in all of our Brandon, you're in two of my chat groups. I'm in a few others. I haven't been really responsive to many of them at
Right.
all. I've
You're
been kind of
still
quiet.
in GE Vernova, right?
No, I sold out. I mean, I made a ton of profit, but I sold out
Yeah.
last year.
Okay. So but anybody who still has this needs to hold it and buy
Is
on
it is
dips.
it down recently?
I don't know. I don't even know. I don't even pay attention to the day to day movement.
What, you own it. You still own it.
I
Why would
know,
you not
but
pay
I pay
attention?
attention to because I pay attention to the news. Here, let me look. Let's look at it. I pay attention to the news, but look,
While you're
I
pulling it
have
up,
I have
let
a
me do.
total of 20 assets in my portfolio. 19 of them were 18 of them are stocks, and one of them is a SPY ETF.
Gotcha.
Right.
Well,
So I
while
don't
you're
pay
pulling
attention
it
to
up,
day to
let me
day.
do our introduction to the show, and then you take over and pull after you pull this up. So rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You hear the lie back and forth, the bicker and the banter right here on the show for you. Brandon, tell us what the chart says, and then take it away.
It's not down at all year to date. Just since January 1st, it's up 21%.
Oh,
So
there you go. See,
yeah,
even
maybe
better.
you wait for a pullback on it, but man,
I
they're
missed out on an extra 20%.
they're just really consolidating here, but not the stock itself, but they are consolidating in the industry, and they're becoming the pure power play. Alongside, I think Vistra is going to be an up and comer in this area too. But GE Vernova is an absolute must hold. I did not plan on covering this, so I don't have
You're
everything in
fine.
front of me. But they're spectacular. Just owned strong buy on GE Vernova, strong buy on ASML, and all these these technology companies that have pulled back that are fundamentally operationally strong. Nvidia with a pullback is just absolutely ridiculous.
Well,
Why?
Jensen Huang, he's staying away from the India summit, the India AI summit that's coming up this next week. He's saying he's not, Nvidia is not even going to go as a company.
Okay, I don't know
But
why,
isn't that
but
weird?
yeah, it is.
What's going on there?
I don't know. They
I don't know
pass.
either.
If you go to the chinchilla pick, I'll just get into this. I was going to do this last, but I'll just get into it real quick. I'm not going
Just
to
get into
grade.
it. Let's just do it. Let's just go.
Let's just do it. I'm not.
It's our show. We do what we
Look,
want.
if you go to the Chinchilla Picking Podcast website, go to the articles. There's an article written about how to grade a stocks. We've talked about it over and over and over on this show. Run that for NVIDIA. They pass everything with flying colors. Here's one thing I like to add to that during market corrections, especially when the Nasdaq and the S&P get corrected and people start taking profits on these tech stocks. Add the PEG ratio must be at or below 1. There are very few times every year where you will get quality companies with forward PEG ratios below 1 that meet the rest of the criteria. Now is one of those times. NVIDIA passes all criteria, flying color. Buy NVIDIA. That's just what I want to say. And so if you, I'll do just a little bit of explanation real quick on the criteria that's on the Chinchilla Picking podcast. All right. Um,
It's actually
so
chinchillapicking.com.
chinchillapicking.com. Yeah, I actually made that mistake this morning. I went to chinchillapickingpodcast.com.
I
That
don't know
doesn't
why.
chinchillapicking.com. That's what
Yeah,
exists.
it's Chinchilla Picking LLC, chinchillapicking.com, Chinchilla Picking everything. But you call it the Chinchilla Picking podcast because that's what
Right.
we try to push people towards.
So all of these, by the way, are pulled directly from Warren Buffett's playbook. So if you say, I don't know who this Brandon Beaver guy is, well, he may not have the best credibility. I don't know him personally. This is all pulled from Warren Buffett. This is what Warren Buffett uses to value his stocks, right? So does the company have sufficient net income to pay off its long-term debt within 4 years? This is like the primary indicator of the firm's defensive strength, its debt servicing capacity. We want it to be able to pay off that debt within 4 years. If it does, it passed. Do they spend less than 30% of the gross profit on selling general and administrative costs? That's the SG&A efficiency rule. Um, we're just looking for company efficiency on this, right? There's a lot of different criteria here to certify that the company is efficient other than just this, but this is one of them. Gross profit margin 40% or better. We're measuring the efficiency of the company, right? Depreciation less than 10% of gross profit, and does also interest expenses kind of align with this too. So interest expenses, are they less than 10% of operating income? This criteria is looking for firms with interest expenses lower than 10% of operating income and depreciation lower than 10% of gross profit. This is just showing that entities that are not burned by excessive financing costs or heavy physical asset maintenance. Company's net income on historical uptrend is not looking good over the past 5 years. Let's update this to 10, by the way. I had 5 for all of this because usually 5 years was the most amount of data you could get for free out of Yahoo Finance or Microsoft Money or whatever. Um, but now that we all have artificial intelligence, we can do 10% or 10 years.
10 years, yeah. You could
Yeah,
just
10.
run it through AI.
Right. You just run it through AI and you can get it. So update it 10 years. Um, over the past 10 years, has the company been historically generating cash and equivalents? Total assets minus total current liabilities has to equal a positive number. So this is basically the net working capital surplus. This is where the total current assets must exceed total current liabilities, providing the necessary liquidity cushion for operational flexibility, especially during downturns. Property, plant, and equipment costs is at a small percent of gross profit. Return on total assets, we want that to be a high percentage return. On the article, I don't specify, and that's because it's really industry specific. This is, like you're buying a house, so you got to compare what the cost of the house is versus what other houses have sold down the street, right? To see if you're getting a good deal. It's kind of the same thing. If you look at quality firms, they generate superior returns on both assets and equity. So you want your return on assets to be good, return on equity to be higher as well. Good return on assets, like the median is generally 5%, but some can get to up to 20%. Let's see, return on shareholders' equity, you want 15% or better. Over the past 10 years, have we shown consistent growth in earnings per share? Do they spend a small portion of their income on capital expenditures? This is one thing, by the way, that has gotten a lot of attention over the past month with Microsoft and Amazon and Meta announcing their capital expenditures on AI. Go ahead, Dave.
I just want to say, for those of you who are listening right now, Brandon is just reading off from the article. You can actually go to the article and read this for yourself.
Right.
And which is what I would have just recommended you do and say, here's a few addendums. Other than that, article's right there. Read it. Good. It's going to cover the stock, right?
Sure. Okay. Well, I mean, we do this for free. And so this is a good
We
thing
do
for
this for
people to
free.
listen to the podcast and you can hear kind of my explanation as to
Okay.
why I have the stuff in here.
We do help a lot of people for free, by the way, too.
When I say spent a small portion of the income on capital expenditures, That I mean, what we're talking about is a 10-year capex intensity ratio is what it's called. Um, that's also industry specific. So like asset light tech stocks, ratios below 5% are common. Capital intensive sectors like utilities, manufacturing, telecom, a good ratio between 5% and 10%. Big tech and AI growth, modern tech giants like Microsoft, for example, are somewhere now between 10 and 20%.
Gotcha.
Also, you want to look at that in relation to like how fast is the company growing, or how fast is the company growing on those assets, and all of that stuff, right? So like um looking at Microsoft and Google on their capex for this year that's caused so many heads to explode. Look at the free cash flow they have and the earnings that are coming in.
They got the cash to cover it. Like, I
They're
don't
going
know
to be
why this
fine.
is. Yeah, I'm sorry. I'm about to get on my soapbox. I don't know why that's such a big issue. They're spending all these billions of dollars on AI and data centers when they're getting a return on their money. They are investing in something that's going to be fantastically huge. I'm all for it. You got to spend money to make money. Everybody understands it until the companies start spending tens of billions of dollars on something. Then they freak out. And then they realize, oh, yeah, they're going to make tens of billions of dollars.
Yeah, they're going to be good. You know what happens? I think a lot of big whales start taking profits that have done really, really well in these stocks, and they look at their underperforming assets that they think, are at a value and that they think could jump up. They cycle out of tech, they go into these other assets, and then their tech stocks keep growing, right? Because they don't really need that as much money in these tech stocks to make a lot of money. They have to be really, really like risk adjusted for their clients. So if these positions grow way outside, outsized, comparatively speaking to their other positions, they got to readjust,
So they'll be
shrink their position.
overweight and then they have to make it equal weight.
Right. But they're overweight because the stocks are doing really freaking good.
Yeah.
So it happens. But then, CNBC jumps on and everybody goes negative because there's selling pressure, there's a correction, and they start to say, oh, it's the capital expenditures, which is probably, it's a reason, but it's not a great reason to sell
It's
out.
a reason.
Right. So people start looking for reasons to sell these stocks because like they're panicking because they're seeing their portfolio go down.
Yeah,
But it has nothing to do with the fundamentals of the company.
exactly. And I'm going to get into that in a story and a sector I'm going to talk about later on in the show. But yes.
Right. Nvidia passes every one of these, including, by the way, the last one, which I'm adding forward price to earnings growth ratio near or below one. I want that. And this is actually below one. This is the forward looking, what the company's projecting 12 months out versus what you're paying now. And you're paying less than $1 for every dollar of earnings that you get. That's a freaking good deal. That's like almost free money over the
Yeah.
long haul because it will equal out. The share price will catch up with the growth of the earnings. So, I mean, not let's not grade the stocks here like all of them based on all of these credentials because this is just going to get too boring if I do it. But I mean, I'm just looking at Google is a company that passes these, and I always want to look for 80% or better, but NVIDIA gets every one of them. So Google, NVIDIA, Adobe falls on the list, but I don't know how much AI is going to eat into their future earnings. So kind of iffy on Adobe.
Hmm.
You can run this screen, by the way, with Google's Gemini. I do it every week.
Nice. Really
Yeah.
good. You
Go to
should post.
chinchillapicking.com, copy and
You
paste it to Gemini, and
really
just
just
yeah.
copy and paste it and it works.
Yeah, just copy and paste it. Say I want stocks that meet 80% of the below criteria. I would say for me and using those because we're looking at companies that have to be profitable. So look at large cap, mega caps. Small caps might fit into, but large cap, mega caps just to filter it down. And you can even tell Gemini to, hey, run this report every Wednesday at 6 p.m. if you want.
Nice.
Right.
Having Gemini do your work for you.
I
Love it.
needed I needed something to the first like 13 or 14 whatever criteria that are in there, it's all based on stock fundamentals, company fundamentals, and all of that. Valuation matters. So I added forward peg ratio below 1 because we
Gotcha.
want to, get a good value growth kind of thing going on. Um, with that being said, I think you could even take out the forward peg ratio because history shows that good companies that are running really well, um, a blind monkey could pick 5 stocks based on those and then probably still outperform the market over the course of 5 to 10 years.
There you go.
Yeah. How much time did I take, Dave? Did I take a while there?
Not a whole lot, man. We still got plenty more to go, so
Good.
I'm
All
ready.
right. Because I want to talk about the Netflix merger.
I don't know why you want to talk about this again. Again.
I
Here
didn't
we
talk about
go.
it
Let's
that much.
talk about this again.
I did not deep dive.
I'm
Stop
gonna
picking
steal your
on me.
thunder real quick because Wall Street Journal reported to just today that Warner Brothers has reached out to Paramount to open talks again with them. That was reported today on the Reuters Newswire that Warner Brothers reached out to Paramount, not the other way
Okay.
around.
So if you weren't listening to the previous podcast, Netflix has an $82.7 billion deal.
Brandon has talked about this every single time. Go ahead, Brandon.
I
Sorry.
don't think I have, dude. I really don't. I
Ever
haven't
since it got announced, I think you brought it up every podcast.
not no deep dive.
Okay.
No deep dive on
I,
them.
I would disagree, but go ahead.
Okay.
Deep
So
dive again.
there's an $82.7 billion deal to acquire Warner Brothers Discovery Studio and streaming assets, including HBO Max, with a revised 27.75 $27.75 shared all cash offer. So
By
that's what we're
Netflix,
talking
right?
about here, right?
That's
By
by
Netflix.
Netflix.
Paramount's jumping in here, and I'll talk about Paramount here in a second. And I actually, well, let me talk about it here in a minute. All right. So the structure of this deal, Netflix is getting the film and TV studios and the streaming services. Warner Brothers is separating the cable networks like CNN, TNT, and all that's being spun off into a separate entity called Discovery Global. The $27.75 per share in cash with a total enterprise value of $82.7 billion. 10 billion dollars of the debt is going to Netflix. $17 billion is going to the linear Discovery Global. That's why some are showing this or saying that this is a poison pill. Because if we were to value the Warner Brothers Discovery deal, most analysts are saying this is about $14.4 billion. And you're saddling it with $17 billion. Meanwhile, linear TV is dropping off a cliff. It has been for 10 years. Disney earnings show that accelerating. Comcast just separated Versant from itself, and Versant's its linear media deal. The stock fell off a cliff almost immediately because it's declining. This is a completely declining industry. So you're saddling $17 billion on Discovery Global that analysts are saying this is $14.4 billion company. You're automatically like negative here. That's why I think the Discovery Global thing needs to be changed because it's almost a poison pill here. Bondholders are going to hate this. Stockholders, if you bought in right now, buying into Warner Brothers deal right now, terrible.
So the Discovery Global spinoff that has the linear channels that you're talking about, which were what were they again? Some examples of them.
So CNN, HGTV, TNT, TNT
Yeah,
Sports was part of the deal. They just lost their NBA deal.
yeah.
There's no
Without NBA, TNT doesn't make sense.
right.
Now that group right there just needs to be spun off separately and then shut down. If there's 17, I mean seriously, if we're paying 14 billion and that's 17 billion of debt, write it off, shut it down,
What
I
are the
mean, you buy it up and
the
you just
bondholders that own that $17 billion of debt? Where are they going to go?
nowhere to bankruptcy court
They're
because you're not
done.
getting a dime.
Right.
You're not getting
That's the
anything. You're
problem with
done.
this deal.
So the bondholders are out of luck, but that's the risk you take when you invest in companies is that there's a chance it could go to zero. I tell everybody that there's a chance that every single company you invest in, even Nvidia, there is a chance. Now with Nvidia, it's a very small to non-existent chance, but there is a chance it can go to zero. That's the risk you take.
Now, here's one deal that people aren't paying attention to that makes this, the way that it's structured, almost even more impossible. So, Netflix likely has to legally do this deal to spin off the Warner Brothers media because what they're going to do, and I don't know where Max is still going to stream, but they're still keeping the live sports that they do have, right? Netflix just made a deal, and sorry, Dave, we live in America and you're talking to a self-professed hillbilly. Everything comes back to professional wrestling, right? Netflix just made this deal with WWE to stream Raw. Most of these deals and these streaming deals um, say in them that you cannot stream our competitor as well. Now, Warner Brothers owns HBO Max, which streams AEW. It's one of the reasons why Netflix most likely cannot stream the sports here because they've got WWE. Now, Dave, you could say, well, if that's the case, drop WWE, right?
Now drop AEW. WWE is more
Yeah.
profitable.
Okay, good. There you go. Because I was going to say, well, if you got to drop WWE to get the Warner Brothers deal, um, the partnership in the first year, and look, in 2025, subscribers from WWE fans have watched a total of 525 million hours of WWE content. Raw gets 3 million per week. You can't drop that. So AEW's got to go somewhere else. That's why I'm
It's
saying this Discovery thing might be a poison
it's
pill.
a mess. The whole thing's a mess. From an investment standpoint, I'm not touching any of it.
You don't
They
want to
got
buy.
to drop the loser linear portion of it. It's just got to
Right.
be dropped, closed out, shut down because it's not making any money. It's in the hole. Close down those networks.
Well,
Sometimes in life, I mean, if someone's like, well, these networks have been around forever, you know what? Let me ask you this. Let me ask a young generation. What's the latest generation that's just turned 18? What, Y, Z, something like that?
right.
Yeah. Let me ask one of them. Hey, have do you bank with Lehman Brothers? And see what they say.
They're gonna who? Who?
Do you bank with Merrill Lynch? So and here's the thing is they're gonna yeah, exactly they're gonna say who do you bank with Washington Mutual? And the point I'm making is sometimes these big companies that have been around over 100 years gotta go, and that's just because they poorly performed, they lost out, they're now worthless. Get rid of them.
Right. Now here, if I'm a Warner Brothers shareholder, here's why I'm voting for the Paramount deal. $30 a share offering right now, so better already than Netflix's. Beyond that, they are now offering a 25-cent per share ticking fee, which is equivalent to $650 million per the current quarter, payable to Warner Brothers shareholder for every quarter the transaction is delayed beyond December of this year. I think it's by far the superior deal. Now, Warner Brothers says it's not because they say Paramount's financing is on shaky grounds. So I don't
Warner
know where they're
Brothers
getting
is
that.
on shaky grounds.
I know. Well, you know what? Warner Brothers is still profitable. So that's one of the positives here for Netflix is that it's operationally profitable on day one. Now, Netflix tells us by 2028 they'll get all the money back. The deal will be profitable and accreditable to GAAP earnings, so generally accepted accounting principles earnings. They're saying by then this will be profitable. So likely 2027 or 2028, depending on the close of this deal. Netflix management is anticipating that the combined entity will realize about $2 to $3 billion in annual cost savings by the third year. and then following the deal's closure. So we're looking at it being accretive to earnings 2 to 3 years from now, and then also the cost savings 2 to 3 years from now. I see this no matter what, Dave, as a reason to buy Netflix right now on this dip and to accumulate it.
What's
And
Netflix at right now? Last time you checked?
like $80 a share, somewhere around there.
Hmm.
It was down quite a bit, right? But
Yeah, down quite a bit.
again, Netflix passes every one of my criteria, all 14 of them. The depth goes through. We'd have to look back at the depth issues and stuff like that if the deal goes through. But it right now it passes all the criteria, and every acquisition that they've made has been very successful. This is the largest.
Yeah.
And then people, I think, are also looking back at the Disney deal to acquire Fox and what happened with that. It wasn't so good towards the end. So I think people are a little worried here. But Netflix, the way that this is going, is really good for Netflix, not so good for Warner Brothers shareholders, in my opinion.
Okay.
Um, one more negative here, one thing that I don't like about it, because of this competition now with Paramount, they've had this deal where they've been leasing um, media from these other companies, like Paramount, for example. Like, right, they're getting Paramount movies
Yep.
on Netflix. I think that stops. I don't think Netflix is going to be getting any other major movie deals from other companies anymore. They're going to own 30% of the streaming market. They're going to own a large percentage of the movies and cinema. And I think people are going to view this as massive competition now. So that's one negative here. I think that like Netflix is facing this frenemy period where studios were licensing content to Netflix to offset like, other losses that they were having. I don't think they're going to do that anymore.
Gotcha.
But the deal gives them, like I just said, 30% of the streaming market. I don't think people are realizing either, like what kind of
Dude, look. All right, look. People realize it. You're calling Netflix a buy. They're going to get 30% of the market. This is a good deal for Netflix, right? They're going to separate the linear, drop it off. It's all going to be good.
okay. So I don't think people are understanding the fact that any Batman franchises, any Hogwarts franchises, that's going to be huge for Netflix. The Paramount library, not the Paramount, but the Warner Brothers library that is coming over, the amount of streaming that's going to have people binge watching the binge
I think
watching.
this would be huge for a company like Sandbox VR, which has a VR license and agreement with Netflix. That if Netflix acquires the rights to Harry Potter and Batman and Marvel, not Marvel, but Harry Potter and DC Comics, then you can now play those kind of games at a VR place like Sandbox VR, and that will be huge for that company.
The binging that this is going to create, again, not only is this going to add more subscribers for Netflix, but it's going to also increase the amount of money that they're making from their ad tier.
There you go.
All right.
Awesome. Let's move on.
Okay.
Then next week we could talk more about your Netflix deal again. Um,
Now I'm done with it now.
I don't think you are. I think Netflix next week you'll bring it up again. Here we go. I want to talk a little bit about cryptocurrency. This is something that's been in the news recently. I know Brandon sent me a nice smart text a couple weeks back about whether or not I consider a Bitcoin still, or wasn't it? It was Nick Young, one of our contributors, whether or not I still consider Bitcoin a safe haven place to put it. And I believe it was on our last podcast that you and I did together, was 2 weeks ago, where we were going through the earnings for the week, and I said, "Look, I want to look at these mining companies because I believe Bitcoin is going to be dropping, and I wonder if this is the point where these mining companies drop as well, and whether or not the Ethereum and Ripple and all these other coins start separating and moving separately from Bitcoin." And that was the statement I made, and that was about 2 weeks ago. Well, then Bitcoin dropped even more. And we did see a separation for a brief moment of Ripple and Ethereum separating themselves and starting to move on their own, but then they came back, right? So
Right.
you don't want to hear from me, just like Brandon said, you don't want to hear from Brandon Beaver. You don't want to hear from David Underwood all about Bitcoin here. So let's talk about like a company that you can rely on, right? BlackRock. So what does BlackRock have to say about Bitcoin and what happened? So BlackRock released this article that was done with them via CoinDesk on the BlackRock's quoted throughout here using what's the name of the guy here? Robert Mitchnick, right? He's the head of digital assets at BlackRock. So the head of all digital assets at BlackRock, Robert Mitchnick, he's quoted throughout this article. The article headline is BlackRock's digital assets head, colons, leverage driven volatility threatens Bitcoin's narrative. This was released this morning at 9 a.m. So 2:15:26 at 9 a.m. This article came out. And here's what some of the things Robert Mitchnick had to say. Here's a quote from him. These days, we have a tiny little thing that shouldn't have any price impact really at all. And if it does, it should be small. Like, for example, October 10th, some tariff related thing. And next thing you know, Bitcoin is down 20%, Mitchnick said. That's because you get cascading liquidations and auto deleveraging. What does he mean by auto deleveraging? That's the key here, right? So people have been using Bitcoin as a hedge, a portfolio hedge. So they've been using it, Brandon, and then they've been using it as their collateral when they're leveraging on these other riskier stocks.
Why?
So hold on, it doesn't matter why, as far as what in regards to crypto or Bitcoin or what, as far as what I'm talking about. The why is moot point. Doesn't matter. So here's why this affects Bitcoin so much. When these other stocks and these other ETFs or other whatever starts dropping tremendously, well, guess what you have to do now when you've used Bitcoin as a collateral? You have to sell your collateral in order to cover your losses because you did it on margin, you did it on leverage. So thus, Bitcoin has been dropping because people have been using it as a treasury, which you've been voiced against, Brandon.
Yes.
Good for you, but they've been using it. So now they have to sell their quote unquote treasury, but in this case, Bitcoin. And that's why you see a big drop off in Bitcoin. So here's Mitchnick. He goes on to be quoted by saying there's a misperception out there that it's a bunch of hedge funds and ETFs that are creating volatility and selling. That's not what we're seeing. On a week that was tumultuous, obviously in the Bitcoin market, we had a 0.2% of the fund redeem. That's it. 0.2% of hedge funds redeem their Bitcoins, meaning sell.
Right.
If there actually were hedge funds massively unwinding trades, you would have seen billions. And we see millions, we see many billions liquidated on these leveraged platforms. So, despite short term turbulence, Minchik emphasized that BlackRock remains committed to digital assets as part of the broader financial transformation. His quote is he ends with this quote: "We see ourselves as having the role of a bridge between traditional finance and the digital asset world. Over time, there is certainly going to continue to be a greater role for digital assets in this technology theme in general for many of our clients." So, and there's other articles that say a particularly similar theme here. It's when people started using Bitcoin as their collateral, their base to leverage from, and then the market took a dive and people had to sell their leverage in institutions. He's saying that's what caused Bitcoin to drop tremendously, was the market dropping overall.
So what you're saying, the fundamental reason for investing in Bitcoin has not changed, but a bunch of whales in the smart money category screwed up and had to sell this Bitcoin
To cover
when
the
they
losses.
didn't necessarily really want to do it because they had to. And here's where retail has been so freaking good. And by retail investors, I mean individual small investors have been really freaking
Yes.
good. Over the past 5 to 6 years, they recognize this and they buy those dips. And I've never said that Bitcoin was not a good investment. I've said it was not a good safe haven, which is a different thing, right? So
Yes.
if you're trying to, leverage something and with a safe haven, it should be with treasuries or something a little bit more durable and I don't want to say
Now,
durable,
here's
but
my question. If they had
more
bought treasuries
predictable.
instead, Brandon, and they had to all of a sudden sell all these treasuries at once, what would that have done to the treasury market?
Drove the interest rates up and the price of the bonds down, which would have been a buying opportunity for treasury owners as well.
And that's why
Same
we
thing.
haven't seen that relation because they've been talking about there's an inverse. The relation is ship has been broken the past few months. Well, that's because people moved away from treasuries as their go-to and they moved into other assets as their go-to. And that's
Right.
why you saw that relationship break over the last 3 to 6 months. And they've reported that talking heads on Bloomberg and CNBC have been talking about the relationship breaking. That is why people are
Right.
using other assets to use as collateral rather than U.S. Treasuries.
So it's a buying opportunity.
Maybe, because here's where we go into the next point. Ready? Talking about U.S. Treasuries.
No, I
So
mean
this
the
are
buying opportunity for Bitcoin.
oh yeah for
Yeah.
Bitcoin, yes, yes. So here is an article that came out this morning at 6:12 a.m. on Bazinga, which I don't really like Bazinga, but this is a decent article here. It says the U.S. Here's the headline. I'm just going to read the headline and then I'll get into why I'm reading this article. The U.S. could soon enter a debt spiral, exceeding post World War II debt to GDP
Yep.
record by 2030, Watchdog says. The watchdog they're referencing is the Congressional Budget Office, or CBO. That's typically a watchdog that most people use. It's very, very well regarded. So what the CBO is saying that at the current pace, publicly held debt stands at 31 trillion, equating to roughly 100% of the nation's GDP. So we hold as much debt as we take in each year, right? By 2030, the debt is expected to exceed post World War II record of 106% and could reach 120% by 2036. This increase is driven by rising annual interest costs. So we need to quit taking out these bonds and loans here, which are projected to more than double to 2.1 trillion by 2036, further straining federal budgets and increasing deficits. Not a good thing to have. The Treasury Department is experiencing higher bond yields influenced by previous federal rate hikes, concerns over the U.S. global financial reliability. The average interest rate on federal debt is currently held at 3.316% and is expected to rise to 3.9% by 2036, according to the CBO. Now, it ends on a positive note here, and this is kind of weird how they spin this. You ready, Brandon?
Yeah.
The rise in U.S. debt has been a growing concern among economists and policymakers. Richard Haass, president of the Council on Foreign Relations, has warned that the 38 trillion national debt poses a significant threat to the country's security and global standing, potentially leading to a national security crisis. Additionally, the impact of President Donald Trump's tariffs has been a double-edged sword. While they have driven the S&P and Dow to record highs, they also risk increase in household costs by 1,300 annually. Despite these challenges, the U.S. economy shows signs of strength, with the Atlanta Fed's GDP Now model predicting a strong 5.4% GDP growth in Q4 of 2025, marking the strongest quarterly growth since 1984.
I want to both high five that guy and also punch
Right?
him
And
at
no,
the same
he gets
time.
us. He gets two different emotions out of reading this
Right.
article.
Because here's the thing, the S&P 500 and the Nasdaq were not driven to record highs by tariffs, and neither was the Dow.
Yeah.
That's not how that worked. The Dow was driven to record highs by the financials, which have been doing really well because of high interest rates.
Yep.
The S&P 500 and the Nasdaq were driven higher because of artificial intelligence and the innovations being made there. It's not been
Yeah.
because of tariffs. Now, everything that he's saying about treasuries, I agree with. And Ron Paul, one of my favorite presidential candidates of all time and best congressman of all time. I've got his autograph behind me on the wall somewhere. I don't want to get political, so don't hate me for what I'm saying. I'm not taking any positions here. He's right about the debt. Funny thing is, I didn't read that article at all, but I let the majority of my treasuries mature on Thursday, February 12th, I think it was their maturity date, and I just took
Okay.
the money. And I'm thinking about selling my last one that I have, and I told you why on the um, group chat that we have. Thinking about selling the last one I have on Monday. But the reasons for those, me letting those mature and then selling this other one, it's honestly because my free cash has dwindled so much during this recent dip because I've just been buying and buying and buying and buying. I need more cash on the side. So
Yep. It's a good place to store your cash too. That way you earn some money while you store the cash.
it's highly liquid and you get something for it, right?
Yeah.
So that, I mean, that's, but I mean, I am worried about the debt. I have been for a long time. So,
There you go. It's
but
something to think
as
about.
long as we're the military power, the military superpower of the world, and I hate this because I'm anti-war, but as long as we're that military superpower, I don't think that our economy is going to crash because of that.
Yeah, and with that high GDP number, which is outstanding if we actually hit that 5.4% GDP for the
Right,
quarter,
right,
that's ridiculous. I mean, if we hit that, then that means the economy's humming along and everybody's going to be happy and the market's going to move higher.
right. Recent job numbers that just were
Yeah.
released were good as
Job
well.
numbers
So,
were higher than better than expected. Everything's showing better than expected. It could be a rosy Goldilocks economy here for 2026, and the January barometer could be right again, Brandon.
right, right. I think all these dips in tech stocks are gonna
Buy,
people who
buying
sold. They're
opportunities.
right. People who sold, I think, are gonna really regret it.
Yes, I agree as well. All right, let's get into earnings this week and then final thoughts. Here we go. Tuesday, going to zoom right through these. After the bell, we have Devon Energy. They specialize in data centers, specifically in the Michigan area. So I want to take a look at what they have to say as far as data centers goes. This next one I mentioned just because Brandon owned this at one point and then sold it. Halozyme Therapeutics. Halozyme Therapeutics
Yeah,
reports on
yeah, yeah.
Tuesday. Let's see if Brandon sold too soon. That's
I
what I put
probably
here as a note.
did. I have been so terrible with pharma stocks and healthcare. I just United Health I did well with, and then yeah, I think that was the only one.
Gotcha.
So
So moving on to Wednesday, I got Wyndham Hotels and Resorts. It's giving us a good look at spring travel. It's a good look at the health of the economy. I'm more interested in their guidance going forward, what they expect this year as far as travel and leisure.
you know what, Windham, that was one that I was looking at for for a value play like a year ago, and I just became super concerned. And the reason why I didn't buy it was um, betting is legal in almost every state now, right? And you could do
Yeah.
it from your phone. So a lot of people aren't going to the casinos,
Yep.
Vegas, and I think even the stats showed that the Super Bowl, Vegas visitorship for the Super Bowl was down like 10% year over year. And it's
Yeah.
probably the same thing. DraftKings, for example,
Yeah.
you just get on your phone and bet the game from your living room now.
People
So,
are not going to my tribal casino. So
right.
Thursday. Thursday before the bell, we have two huge ones. John Deere gives us a good look at the economy, especially farmers and that market. And also, Walmart. Walmart actually announced they're going to start selling gold as of tomorrow. So you can buy gold
Gold,
on Walmart.com. Gold.
they're copying Costco, huh?
They are copying Costco. So you can buy gold now starting tomorrow at Walmart's. And
Are
then
we in a
also
gold
one,
bubble? Do you
huh?
think? I mean, if
Gold is
that's
above
happening,
5,000 an ounce right now.
it's
Gold is
crazy
killing.
high, right?
Yeah,
Yeah,
I
it's
remember
killing
I
it.
bought remember I bought gold when it was at 2,000 some odd an ounce and I said I'm going to throw it in my safety deposit box. I'm just going to keep it. Yada yada yada. And now I've almost doubled, Brandon. I've
I
almost
would.
doubled my money on it.
I have never said those words. Do you think we're in a gold bubble before? But now you're saying Walmart's selling it. And I'm kind of like, maybe I don't know.
As soon as we get the ATMs around the corner, then we'll have a thing.
Right.
Um, Klarna payment system. So Klarna's on Thursday. That's one of the same thing as the firm. I want to see what they have to say about the subprime lending program, if that's in trouble, if that's not in trouble, or if they're saying we're humming along, we're doing just fine, everybody's making payments, and our delinquency or defaults is below a certain level, which is acceptable for the business, then hey, good for them. So
Okay.
I want to see what they have to say. That's Thursday on Klarna. Final thoughts, Brandon.
You're going to hate me for this.
I already do.
So, on top of everything I already said about the Netflix deal,
Yeah. Oh,
Netflix is also getting Warner Brother games. So, they're getting Hogwarts. I mean, Mortal Kombat is involved in that too, but I think that's kind of an afterthought unless they do something really freaking cool with it. But they're getting the Hogwarts games. So another
Gotcha.
good Hogwarts game was huge for Warner Brothers games. Might be big for Netflix too. And we all know that they've been putting video games on Netflix for you to play mobilely.
We're gonna
To
put a
be able to
ban
play.
on you saying the word Warner Brothers and Netflix going
Yeah.
forward.
Okay, that's fine. Last episode on it, at least. I would probably talk about it again when
Oh,
there's
you're
more.
gonna bring up Disney again too
No,
every
no
time.
more.
So
No, well, I mean, I think that's important because people wonder about my position on it, and linear TV decline is not stopping for Disney, but the streaming is now growing faster than the linear is declining. So that's why I'm kind of like, I guess I'm giving it another quarter. Just
there you go.
there you go.
All right, my final thoughts as we enter this weekend. It is a shorter week. The markets are closed on Monday. They will reopen on Tuesday for President's Day. There's a good sale. Go buy some furniture. I will say this: definitely take your time. Don't rush into anything. I know right now I was a little more honest, about my personal situation going on. I'm taking my time. I'm being very careful
Yeah,
right now. I'm not rushing anything. I'm listening more to Brandon and the other individuals, in my life and kind of going off their guidance because I don't have the time right now to focus and do my deep dives like normal. So in times like that, really lean on other people or maybe just take a break, take a breather.
a good way to make sure that you're taking your time to make decisions, honestly, is to keep your cash in treasuries because it forces you to think about what you want to do. You have to sell the treasury. It's highly liquid and everything, but it's not like cash where you could just click of a button,
Yep.
make the sale. But the treasury, you have to think about, okay, do I want to sell this and take my 4 or 5%, almost guaranteed gain off the table to buy this other stock? You really have to think about it if you do it that way. So
There you go. I like it. All right. As always, we hope we have been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
have a good night.